From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last Friday of the month, January 31st, 2025. Let's check the calendar. It's Winterfest in Lake Geneva this weekend. That's always fun. The cover band Eclipse is during Pink Floyd's Dark Side of the Moon at the Marcus Performing Arts Center, and that should be cosmic. Back on Earth. The Bucks have a home game with the Grizzlies Sunday evening and then hit the road for a full week. Let's start off in Copenhagen, where anthropologists are all excited. They found 66-million-year-old fish vomit. Suddenly, I don't feel so bad about my career choices. Now for an ugly baby story. As we learned from grandmothers, there is no such thing as an ugly baby. But here's the dilemma. Why didn't this unattractive baby look either like their attractive Asian parents? Dad finally did some digging, and after 6 years he learned his wife had not cheated on him, as he suspected, and he is the biological father. The reason for the unattractive child? Mom had $100,000 of plastic surgery done before they met. And finally, there's more evidence that robots are planning to take over the planet. China's E-Town, located in Beijing, is hosting 12,000 humans and their humanoid robots. More than 20 companies are competing in a half marathon, roughly 13 miles. The robots cannot have wheels. They must be between 18 inches and 6.5 feet tall and must have a humanoid appearance and be capable of walking or running the distance. Pretty soon they'll be playing pickleball. On the podcast today, we have Dave Sandstrom, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A bit of a tough week for some of the recent market leaders. The Dow Jones Industrial Average, however, positive on the week, up 0.3%. That's 120 points. Closing at the bell on Friday at 44,544. The NASDAQ, though, down 1.6%, down 327 points. A terrible Monday, a terrible start to the week. We'll get into that. And the S&P 500 down 61 points on the week, closing at the bell at 60.41. That's down 1%. For the year, including dividends, the NASDAQ up 1.7%. The S&P 500 up 2.8%. A pretty stellar return so far through the first month for the Dow Jones Industrial Average, up 4.8%. And the benchmark yield on the 10-year U.S. Treasury down this week to 4.57, pretty much where it started the year. A little bit of a rounding error there, but pretty much where it started the year. NASDAQ, clearly the thing in focus this week, Tom, and I think a lot of it started on Monday with a conversation around the Chinese artificial intelligence platform DeepSeek. Some news that potentially they could do the things that their American counterparts, things like ChatGPT, could do, but do it for far less resource, with far older technology, and obviously, as a result, for far less money. The kind of market leader, NVIDIA, one of the big producers of graphics processing units necessary for those artificial intelligence computations, sold off drastically, the biggest one-day decline we've seen in a stock in U.S. history, almost $600 billion in market decline. I think a pretty rough start to the week, and then maybe things seem to settle down a bit coming through the week as we started to get a little more understanding of just what all that meant. But I think, a lot to be said potentially for what otherwise might have been kind of a discounted headline.
Yeah, I think like all things, this is the newest and the latest headline. And I think for the longest time when looking at the entire artificial intelligence space, you get a news headline like this, and it's kind of made you rethink the narrative that here's these largest companies and they're solely responsible for the artificial intelligence movement. And now that's kind of being, possibly tossed into question right now. And I think it's too early to know. I actually had a client shoot me an email just kind of about this because they've been very interested in artificial intelligence. And what does it all mean? I think my answer is kind of like a lot of this year is that it's too early to really know, but it may not all at the same time be all necessarily negative. We're introducing more competition. We've kind of talked about this week, and I think you sent a message to us that, introduces, if there's a more efficient or perhaps a better way of doing things, you may bring all these other competitors to the table, and that might make it more deployable to everybody at large, and that can ultimately be a positive for consumers.
I also think it brings into light, Kyle, something that you also mentioned today, is that might be offering some nervous investors an opportunity to run to the door. I think that was a pretty swift and quick decline for something that was really unproven and really not vetted very well. So I think that does point to the fact that valuations are very, very high right now, and everybody, I think, has got their finger on the trigger a little bit to say, okay, I have to be very careful here. If something looks weak or I see something that maybe looks to be concerning to me, that I better be ready to move. So that's a bit of I think a concerning signal to me.
I think I look at any time you see that kind of market movement, you start to overemphasize those single headlines. A single headline, by the way, that largely came out of the Chinese press and Chinese websites. Not that you can't trust it, but I think you should take it with a grain of salt. They're going to put any piece of information in the best positive light they can for their technology community, for their resources. I think you add in the fact that what they're doing isn't blazing a trail. They're not saying, hey, we can do these things that some other system can't do. They're saying we can do things that we've already seen you can do, but we can do it for less cost. And I think there is a difference between trailblazing and just piling onto what's already out there. We've already now seen reports that potentially DeepSeek was just using data sets that other firms had used to train their models. Well, of course, that's going to reduce the cost. Their focus may more have been on how do we make these processes efficient rather than how do we create the process. And I think if you already have some expertise in process, well, the next logical step is let's make them more efficient. And so, I've long been a subscriber to Moore's Law and this idea that we can drive down cost over time as technology exponentially grows. And I think what we're seeing now is that while it will raise questions about, okay, how many GPUs do we need from a company like NVIDIA? How much architecture do we need to build out for these wafer plants? And maybe that calls into question some of the firms that build that technology. But the reverse is also true, that if we are more efficient in doing this, we will need less power. We'll need to consume less power in these data centers, which means the companies making the data centers can be more revenue sensitive, right? That the revenue they generate is going to make its way to the bottom line faster. That the companies that are implementing these changes in the automation space or artificial intelligence more broadly can see a cheaper cost to implementation because there's competition. And I think at the end of the day, that's what we want to see is competition. I'd like for maybe that competition to be on a level playing field, that you don't simply just steal your competitors' data sets and use that as the way to say, well, okay, here's why we're better. But at the same time, it is competition that ultimately is going to drive those efficiencies we need for this to be something that's profitable. It's funny, there was an article that came out referencing kind of FINRA's view on artificial intelligence, and they rightfully cautioned, and it's something that Jason Scuglik, one of our colleagues, has written repeatedly on some of the fraud that's out there and the ability for artificial intelligence to create identities and make them look real, to mimic customers, to mimic financial websites even, to trick people into giving them things they wouldn't otherwise give them. And I think that's the reverse of this that we have to be cognizant of as well, is the more accessible these things are, the more risk there is to us as investors. I think the other obvious point in all of this is just a reminder, Dave, that stocks didn't enter the week cheap. And we talked about it on the podcast last week, and kind of the difference between what you could get buying bonds, what you could get in earnings yield on the S&P 500 and what you could get in an interest rate or a yield on a 10-year treasury or something comparable. And I think there is still some pushback on that conversation because we are still kind of victims of the most recent experience that stocks have done exceptionally well. And especially in a year like 2022, bonds have been anything but what we would have hoped for. And so I wonder how you're navigating some of those issues with clients of, hey, maybe now's a good time to trim a little bit, but some hesitancy to push into a piece of the portfolio that should be a little safer?
I think investors are really suffering from kind of a negative recency bias, we like to call it, and pointing directly to what you talked about, Kyle, where in 2022 the U.S. bond market experienced one of the worst years on record. I'm a little surprised that clients have been so reluctant to embrace bonds again after that, but I think there's a propensity out there to be able to put up with stock market volatility because you kind of expect it. People don't like bond market volatility because they point to that being the safe part of their portfolio. So I can understand it, but I just want to encourage people to maybe drop their guard a little bit on that and return to the bond market, I think, going forward and to reallocate if you have not. And if you are way overweight equities at this point, I would consider those opportunities because it right now with yields elevated the way they are, and inflation looking like it's stabilizing, I think the future does point to some pretty lucrative opportunities in the bond market.
I think to piggyback on what you're saying is again highlight just that fact that yields are high. I mean, we're over 4% on a lot of bonds that we're investing in currently, and comparing that to earnings yield on the U.S. stocks right now, and that's kind of an important headline that came out this week, was just in reference to the equity risk premium that's out there. It's just gone negative. And it's the first time it's gone negative since 2002. And that's just basically a reference to, well, what are we expecting? What kind of premium are we expecting to gain from stocks relative to an ultimately safe asset? And when it goes negative, it kind of calls that all into question. I mean, why would we, if earnings based on price valuations aren't high enough to overcome a completely safe asset like a 10-year Treasury yield, what is the incentive? It just really kind of calls into question the risk that you're taking in stocks at these high valuations, relative to bonds. And so it really even kind of adds to your case to say, hey, bonds are attractive. And if nothing happens with interest rate movements and you're earning 4% yield, then you should be able to collect that coupon. And we got to kind of always remind people about that. But, in fairness, just because the equity risk premium has, turned negative, which is something that doesn't happen all that too often, it's a function of, the other part of that is earnings and where are those going, for this year. And right now they look favorable, and that can turn around. But again, to your point, I think, bonds still present a very good option at this moment.
And of course, I think it goes back to an earlier conversation we were having about looking for excuses. Well, I'd rather have a good excuse than a bad excuse. And I think the better excuse to sell stocks right now is the valuation one, not some headline, right? And so if what we're talking about is, well, we probably wanted to trim stocks a little bit anyways right now. Yeah, it's easy for financial writers to throw out, well, DeepSeek's the reason why stocks sold off. I think when you look at market activity this week, a week, by the way, which should really have been focused on tech earnings and some bigger economic headlines that came out, instead we had that really bad Monday and we spent the rest of the week settling down. You had an implied volatility index, the 30-day, kind of look at what do we think is going to happen, spike about 20% on Monday. All of a sudden it's back down to where it was for most of January, which is a fairly calm place. It tells me that, yeah, okay, we'll occasionally look for those excuses. And when you look for an excuse, you're going to find one. But that really it was more about the earnings piece. We had Apple, Meta, a bunch of others reporting all in line or better than expectations. And then, Joel, a lot of economic data this week. And, maybe the biggest headline is always that all-encompassing GDP number. I think sometimes by the time we talk about it, and then by the time we've had the second and third and final revisions to it, it's pretty old news, but I think it does still paint that picture of an economy that's in a growth mode.
It's a big boatload of information, so that's why it takes long to gather it and to display it, and then they revise it over the month. And it showed that the last 3 months of 2024 ended pretty strong. We've been looking for a weakness in the economy, and although it's slowed down a little from where it was in the third quarter, it still came in at 2.3% pace of growth. And the big number there that I looked at was, we talk about how consumer spending drives 70% of economic growth, and it was going up at 4.2% pace in the fourth quarter, and that's the best showings in almost 2 years.
And I think realistically, the parts of the report that are going to be dissected for months to come now are the inflation numbers. You get PCE out of that, and then we got another version of PCE, the just December look, and a different report later in the week on Friday. But realistically, even the inflation number has moderated, and especially in the areas that should be most concerning to households, food and energy. Yeah, maybe food prices a little bit higher than we'd like still and growing a little faster than we'd like, but energy prices have taken a meaningful step back recently. And so some of that inflation data, I think, points to, yeah, it's not at 2, but it's also not 7, 8, or 9 like we were worried about 2 years ago.
Right. A big thing that happened this week was the Federal Reserve Board's policymaking committee got together, as it does, every 6 weeks or so, and said, yeah, we're leaving interest rates where they are. Yeah, months ago, we were expecting them to have lowered those rates by now. They started doing that in September, put a pause on it, and they're just sort of saying, yeah, we're still in a holding pattern because the economy is growing strong. It's not showing the signs of weakness that they were expecting, and those interest rates, the inflation rates, the PCE number, help me here, the
personal consumption expenditures index.
Thank you. That's the main one that the Fed looks at. It looks at all sorts of data when it's looking at inflation, but that came out today at 2.6%. For the month of December on a year-to-year basis, and that was up 3 times 3 months in a row. So the Fed had raised interest rates to kind of slow down the economy to keep inflation down, and now they're in a holding pattern because inflation is proving to be pretty stubborn to keep down.
And I think it's important for investors to realize that a lot of those factors that are impacting the Fed's ability to lower rates are positive ones, to what you've just pointed to, those growth numbers, the consumer spending numbers being up. So I'd much rather be in a situation where there might be a little too much good economic news as a reason why we might be seeing some volatility in the markets instead of it being all kinds of really bad news about the economy.
Well, and keeping those interest rates up is also helping savers, right? So, what we're talking about with bonds and short-term cash paying off a little more than it has in decades.
It's interesting, and maybe a little inside baseball here, but we send out an email with kind of our thoughts on what we want to talk about for each podcast, and it just struck me that one of the things we hadn't put in there was the very thing you were just talking about, which was the Fed's meeting this week. And what I think is interesting about that is that it was about the only thing we were talking about this time last year. That you couldn't go a week without saying, okay, is the Fed going to cut 1 or 2 times? How many times between now and the end of the year are they going to cut? And all of a sudden, I think in part because the communication has been so good from the Federal Reserve, in part because it's clear what we're trying to accomplish, and it's clear that we're not completely there, we're still well on our way, that I'm not focused anymore on is the rate going to be 4 or 3.5 or 4.5. I'm focused on what else is going on in the world. How's the economy doing? How are earnings doing? What kind of headlines are there that might take us down? So focused, in fact, on this deep-sea conversation this week that I didn't even really stop to think, hey, the Fed had the potential to do something other than what we expected. Now, it was right in line with everything they had said for the last 6 weeks, really since the last meeting. There wasn't a lot of nuance to the conversation this time the way we had gotten for a while when you were kind of fearing things might shift one direction or the other. But again, I think it's kind of instructive for all of us that maybe that's not our focus anymore right now.
And just to put it in perspective, that 2.6% inflation rate compares to 7.2% in mid-June. That was the problem that the Fed was trying to solve. But it's still not to the 2% long-term range that the Fed wants, but it's a lot closer to that than it was to that peak back in mid-2022.
And then we got some housing data this week, Joel, and it's always a mix, it seems like, in the housing market. But, one of the conversations we continue to have on the inflation front is home prices. And we got pricing data, we got sales data, we got some data on pending home sales as well. And I think all of it paints a continued picture of almost mess in the housing industry.
I was going to say it's a messy mix if it's mixed. The housing prices continue to outpace inflation, so that's a problem. And that's the expensive nature of housing is keeping people from buying other things. We saw today that the savings rate is the lowest it's been for a while because people are spending more than they're bringing in income. But the other thing is that those housing prices are pricing people so that they're leery of buying housing. We said last week that the National Association of Realtors said that the number of houses that they sold in 2024 was the lowest it's been since 1995. Well, we got another number this week from the same association saying that their pending home sales are about 25% below normal. So that's not looking good. One part that you talk about mixed, the new home sales seem to be a little bit better. They look a little better than that, but that's only 1/7 of the housing market. So there you go with that.
Well, you talk about a part of the economy that can't catch a break. When you look at what's going on out in Los Angeles with the thousands and thousands of homes that have been burned, and earlier in the year, you look at the hurricane damage down south, and you're just, we're going in the wrong direction when it relates to creating more housing and housing affordability, because now there's going to be tremendous pressure on contractors to address these situations instead of being able to deploy those resources in other areas of the economy.
To your point about the messy mix, I came across a number just in regards to the number of newly built homes for sale on the market. It's actually the highest it's been since 2009, but like you said, it's kind of a small fraction. But it is leading to some hopefully lower prices, as they say, according to the National Home Builders, that about 30% of builders have cut home prices by an average of about 5%. So hopefully it starts to have a trickle-in effect.
It'll take a while.
It will. It will. One more on the week, Joel, and the consumer confidence numbers. The wonderful thing about consumer confidence is it tends to be that at least the reading of consumer confidence tends to be a little more timely and a little more forward-looking. And so we've got a January kind of index reading level that points to a bit of a step back from where we were a month ago, but overall not pointing to an economy that should be in decline here.
Right. That's a number that came from the Conference Board of Business Research Group, and they basically said, look, confidence in the economy and in people's ability to spend has been trading sideways basically for the last 2 years, and the latest numbers come in kind of at the lower level of that. But people are concerned about the labor market, which we don't hear a lot about, concerns about the labor market, but there you go with that. And, there's still concern about inflation.
Yeah, I think enough tragedies this week that we need to keep all of those individuals out on the West Coast, those individuals out on the East Coast dealing with the aftermath of that crash in our thoughts. We, as always, enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.